to Forex 101. Let me tell you a little more about the history of Forex. The barter system involved the exchange of goods via ships during the ancient times. As the system evolved, salt, spices, and later gold coins were also exchanged. In the 1800s, countries began to adopt the gold standard. The gold standard guaranteed that the government would redeem any amount of paper money for its value in gold, and that transactions no longer had to be done with bulky gold coins because the value of paper currency was now tied to something real. The Bretton Woods Agreement was negotiated in 1944. Under this system, gold was the basis for the US dollar, and other currencies were pegged to the US dollar's value. The Bretton Woods system effectively came to an end in the early 1970s when a free-floating system was introduced, one where the exchange rate is determined by supply and demand on the open market. Governments and central banks regulate currency price and keep it at a favorable spot for international trade. Floating exchange rate systems reflect supply and demand, economic strength, and interest rates between countries. If supply is more than the demand, currency price will go down. And if demand exceeds supply, then the current price will go up. In the 1970s and 1980s, only large banks and financial institutions could indulge themselves in Forex trading. Non-banks could only access the Forex market via a banking relationship. But after the 1990s, Forex trading actually became more decentralized, and even retail traders could participate. That completes this lesson. If you have any questions or remarks, please join my discussion board and make them known. Feel free to follow me on social media and leave this emoji under a recent post for a follow back. Thanks again for tuning in to Money with Mari, and I'll see you on the next episode of Forex 101.